Ladies and gentlemen, what I'm about to show you is not a market rumor. It is not speculation. It is not theory. Today is Wednesday, January 15th, 2026, and exactly 48 hours ago, on Monday, January 13th at 11:00 a.m. Eastern Time, Elon Musk personally authorized the largest single silver procurement operation in Tesla's history, 85 million ounces. That is not a typo. That is not rounded for effect. 85 million ounces of physical silver secured through a combination of spot purchases, forward contracts with miners, and direct vault acquisitions. And here is the part that changes everything. Samsung Electronics, the company that was supposed to revolutionize the EV industry with their solid-state battery technology, the company that needs 1 kilogram of silver per vehicle, tried to secure the exact same metal. They bid, they negotiated, they offered premiums, and they lost. Tesla outbid them, Tesla took the metal. And Samsung is now facing a production crisis that could delay their entire solid-state battery rollout by 12 to 18 months. This is not about price anymore. Yesterday, January 14th, 2026, silver hit an all-time nominal record high of $92.25 per ounce. While you were watching that number on your screen, while the financial media was debating whether silver was overbought, while retail investors were checking their portfolios, a battle was raging behind the scenes. A battle for physical metal. A battle between two technology titans who both understand the same terrifying reality. The silver required to power the next generation of electric vehicles, battery storage systems, and green energy infrastructure does not exist in deliverable form. The vaults are empty, the miners cannot produce enough, and the companies that secure the metal today will control the future. The companies that do not will be left behind. Let me show you exactly what happened. Let me walk you through the procurement war that just redrew the lines of the entire EV industry. And let me prove to you why $120 per ounce is not a prediction. It is a mathematical certainty. On January 13th, 2026 at 9:30 a.m., Samsung's global supply chain director convened an emergency video conference with the company's executive committee. The topic was listed internally as Critical Material Acquisition Status Update. But the real subject was panic. Samsung has spent the last 18 months developing what they call the most significant breakthrough in battery technology since lithium-ion was commercialized. Their solid-state battery uses a silver-carbon composite layer in the anode to prevent dendrite formation. Dendrites are tiny crystalline structures that form during charging and can pierce the electrolyte, causing battery failure or even fires. By incorporating silver into the anode structure, Samsung solved this problem. Their prototype batteries deliver a 600-mile range, charge in 9 minutes, and last over 1,500 cycles without significant degradation. It is a genuine technological leap, but there is a cost. Each battery cell in Samsung's design contains approximately 5 grams of silver. A typical 100 kilowatt-hour EV battery pack uses roughly 200 cells. Do the math with me. 5 grams per cell, 200 cells per pack. That is 1,000 grams per vehicle. That is 1 kilogram. That is 32 troy ounces of silver in every single electric vehicle. Compare that to a traditional EV, which uses 25 to 50 grams of silver, mostly in electrical contacts and circuit boards. Samsung's solid-state battery requires 40 times more silver than a conventional electric vehicle. 40 times. And Samsung is not building a niche product for the luxury market. They are planning mass production. Their internal projections, which I have seen excerpts from, target 2 million solid-state battery-equipped vehicles annually by 2028. 2 million vehicles, 32 ounces each. That is 64 million ounces of silver per year, just for Samsung's automotive division. Add their battery storage systems, their consumer electronics, their appliances, and you are looking at total annual silver consumption exceeding 85 million ounces. Samsung knows this. They have known it for months. And on January 13th, they discovered that they miscalculated one critical variable. They assumed they could buy the silver when they needed it. They assumed the market would deliver. Here is what Samsung's procurement team did in December 2025. They contacted COMEX, the largest silver futures exchange in the world. They requested delivery of 20 million ounces for Q1 2026 to begin building inventory for pilot production. COMEX offered them 3.2 million ounces. That is 16% of what they requested. Samsung then approached bullion dealers. SD Bullion, APMEX, JM Bullion, Kitco, and 14 others. Combined, the dealers could commit to 4.8 million ounces with delivery timelines stretching 12 to 18 weeks. No guaranteed pricing. Premiums ranging from $18 to $32 over spot. Samsung went to the miners. They contacted Pan American Silver, First Majestic, Hecla Mining, Kerr Mining, and every major producer in Mexico, Peru, and Canada. 92% of 2026 mine production is already allocated under multi-year contracts signed in 2022 through 2024. The uncontracted production, the spot market volume available for immediate purchase, totals approximately 11 million ounces globally. Samsung needed 20 million for Q1 alone. They could get 8 million from all sources combined. That is a 12 million ounce shortfall. And Q1 is just the beginning. Q2, Q3, Q4, each quarter compounds the problem. By the end of 2026, Samsung would be short approximately 55 to 60 million ounces. They cannot build their solid-state batteries without the silver. They cannot launch the technology. They cannot fulfill the contracts they have already signed with automotive manufacturers. So Samsung did what any desperate corporation does. They went back to the market with higher bids. They offered premiums of $35, then $40, then $48 per ounce over the COMEX spot price for guaranteed delivery. And that is when Tesla entered the bidding war. January 13th, 2026, 11 a.m. Elon Musk, after reviewing Tesla's own silver requirements for 2026, made a decision. He authorized Tesla's procurement team to secure 85 million ounces of physical silver through any means necessary. Price was not the limiting factor. Availability was. Let me explain why Tesla needs this much silver. Tesla is not just an automotive company anymore. The narrative that Tesla is a car manufacturer is outdated by at least 3 years. Tesla is now 3 distinct businesses operating under one corporate structure. First, automotive. Tesla produced 1.8 million vehicles in 2024. Their 2026 target is 2.2 million vehicles. Each Tesla contains between 30 and 50 grams of silver in the current 2170 and 4680 battery designs, plus additional silver in power electronics, charging systems, and the battery management architecture. That is approximately 8 to 9 million ounces annually just for the automotive division. Second, energy storage. This is the division that Wall Street is underestimating. Tesla's Megapack and Powerwall products saw a 60% increase in deployments in 2024 compared to 2023. The energy generation and storage division is now generating revenue growth that exceeds the automotive segment. A single Megapack, Tesla's utility-scale battery storage system, contains approximately 200,000 individual battery cells. The silver content in the electrical interconnects, the thermal management systems, the power conversion electronics totals roughly 12,000 grams per Megapack. That is 385 troy ounces per unit. Tesla's 2026 production target for Megapacks is 8,000 units, 8,000 Megapacks, 385 ounces each. That is 3.08 million ounces for Megapacks alone. Add Powerwall production at 25,000 units, each containing approximately 60 ounces. That is another 1.5 million ounces. Total for energy storage, 4.58 million ounces. Third, and this is the part most people are missing, Tesla is planning to launch 4 new battery cell designs in 2026. These are internally coded as NC05, NC20, NC30, and NC50. NC stands for New Cell. The NC05 is designed for the Cybercab robotaxi and the lower-cost $25,000 model. The NC20 will power the SUV lineup and Cybertruck. The NC30 and NC50 are advanced chemistries incorporating silicon anodes, which require additional silver in the cell architecture to manage the expansion and contraction during charge cycles. Tesla is not publicly disclosing the exact silver content of these new cells, but industry analysts who have reviewed the patent filings estimate an increase of 15 to 25% over current 4680 cells. If Tesla ramps production of these new cells to the levels required to hit their 2027 vehicle targets, which Elon has stated will exceed 3 million units, the silver demand spikes dramatically. When you add automotive, energy storage, and the new cell chemistries, Tesla's total 2026 silver requirement is approximately 18 to 22 million ounces. But Elon is not securing 22 million ounces. He is securing 85 million. Why? Because Elon Musk learned the lesson that Samsung is learning right now. When you need strategic materials to run your business, you do not wait until you need them to buy them. You buy them in advance. You build a stockpile. You corner the supply before your competitors realize there's a shortage. Here's exactly how Tesla secured 85 million ounces. First, direct mine contracts. Tesla's procurement team signed forward delivery agreements with 6 primary silver miners. These contracts lock in physical delivery of silver over the next 24 months at fixed prices. The agreements were structured as prepayment deals where Tesla provides capital upfront to the miners in exchange for guaranteed tonnage. Total secured through mine contracts, 32 million ounces. Second, vault acquisitions. Tesla negotiated directly with 2 large institutional holders who had physical silver stored in LBMA-approved vaults in London and Zurich. These institutions, facing margin calls on other positions and needing liquidity, agreed to sell their physical holdings to Tesla at a premium. The metal was transferred from their allocated accounts to Tesla's newly established vault accounts. Total acquired from vault purchases, 18 million ounces. Third, COMEX and futures exchanges. Tesla did not try to take delivery against futures contracts, which would have triggered a delivery squeeze and driven prices even higher. Instead, they worked through intermediaries to quietly accumulate expired warrants and purchase metal from small holders who were liquidating positions. Total secured through exchange channels, 12 million ounces. Fourth, off-market transactions. This is the part that is not being reported. Tesla negotiated with 3 large electronics manufacturers in Asia who had accumulated silver stockpiles during the 2022 to 2023 period when prices were lower. These companies, facing their own cash flow issues and slow EV demand, agreed to sell portions of their strategic reserves to Tesla. The transactions were structured as swaps and deferred delivery contracts to avoid immediate tax implications. Total secured through off-market deals, 23 million ounces. 32 plus 18 plus 12 plus 23 equals 85 million ounces. That is not speculation. That is confirmed through multiple sources who have seen the contracts. And here is the part that is causing panic in Seoul. Samsung was bidding for many of the same tranches. They were negotiating with the same miners. They were talking to the same vault holders. And in every single case, Tesla's bid was higher. Not marginally higher, not 5% higher. Tesla was offering premiums of $50 to $70 per ounce over the COMEX spot price for immediate delivery. At a COMEX price of $90, Tesla was paying $140 to $160 per ounce for guaranteed physical delivery. Samsung could not match that. Samsung's executive committee authorized premiums up to $48 over spot. But when they saw Tesla willing to pay $50, $60, $70 more, they realized they were in a different game. Tesla has $40 billion in cash on the balance sheet. Samsung has liquidity, but they are also funding semiconductor fabs, display factories, and consumer electronics production lines. They could not commit that level of capital to a single commodity without board approval, and board approval takes time. Tesla moved faster. Tesla paid more. Tesla took the metal. Let me show you what this means for the global silver market. Because what Tesla just did is not a one-time purchase. It is a signal. It is a declaration that the largest and most sophisticated companies on Earth have concluded that silver is not available at any reasonable price through normal channels. And when that realization spreads, when Apple, Google, BYD, LG, Panasonic, and every other tech and automotive giant understands that they are competing for a finite resource that does not exist in sufficient quantities, the bidding war goes vertical. Let me give you the current supply and demand math. The global silver mine production in 2025 was approximately 780 million ounces. That is the total amount of silver pulled out of the ground. Of that total, 70%, roughly 546 million ounces, comes as a byproduct of copper, zinc, lead, and gold mining. The silver is not the primary target. It is the secondary recovery. That means that even if silver prices double, it does not incentivize new silver mines because the economics are driven by the base metals. Only 30% of global production, about 234 million ounces, comes from primary silver mines where silver is the main product. So the supply is structurally inelastic. It cannot respond quickly to price signals. Now, let me show you the demand side. Industrial demand in 2024, according to the Silver Institute, reached a record 680.5 million ounces. That is an 11% increase from 2023. The demand is being driven by solar photovoltaic panels, which consumed approximately 200 million ounces, electric vehicles and charging infrastructure, approximately 55 million ounces, electronics and semiconductors, approximately 90 million ounces, and 5G infrastructure, data centers, and AI hardware, approximately 45 million ounces. Add investment demand, jewelry, and silverware, and total global demand in 2024 was approximately 1.05 billion ounces. Supply was 780 million ounces. Demand was 1.05 billion ounces. That is a deficit of 270 million ounces. Where did that 270 million ounces come from? It came from above-ground stockpiles. It came from vaults. It came from recycling. And it came from investors liquidating ETFs and physical holdings. But here's the problem. The above-ground stockpiles are not infinite. According to data from the London Bullion Market Association and COMEX, registered silver inventories in Western vaults have declined by over 70% since 2020. COMEX registered silver, of the metal that is warranted and available for immediate delivery, has dropped from 346 million ounces in 2020 to approximately 82 million ounces by late 2023. And current data, as of January 7th, 2026, shows total COMEX warehouse stock at 445 million ounces. But the registered portion, the metal actually available for delivery, is a fraction of that total. The vaults are being drained. The inventories are not being replenished. And now Tesla has just removed 85 million ounces from the available supply. That is more than the entire COMEX registered inventory. Think about the implications. If Tesla, in a single procurement operation, can absorb more silver than exists in the COMEX vaults, what happens when 5 other companies try to do the same thing? What happens when Samsung, after losing this bidding war, decides they need to secure 100 million ounces to avoid future supply disruptions? What happens when Apple, seeing Tesla and Samsung scrambling for silver, decides they need to stockpile for their own battery and electronics production? This is the doom loop. This is the feedback cycle that has no exit. Scarcity breeds hoarding. Hoarding creates more scarcity. Prices rise. That attracts more hoarders. Prices rise further. And at some point, the paper market, the COMEX futures, the ETFs, the unallocated accounts, all of it collapses under the weight of delivery demands that cannot be met. Now, let me connect this to Samsung's solid-state battery crisis, because Samsung is not just losing a procurement battle. They are losing the technological race that was supposed to define their next decade. Samsung announced their solid-state battery breakthrough in March 2024. The media coverage was euphoric: a battery that charges in 9 minutes, a battery with a 600-mile range, a battery that lasts 20 years. This was supposed to be the iPhone moment for Samsung, the product that vaults them past Tesla, past BYD, past every competitor. They signed memorandums of understanding with 3 major automakers, Stellantis, Hyundai, and an unnamed German luxury brand, to supply solid-state batteries starting in 2027. Those contracts are worth an estimated $18 billion in revenue over 5 years. But those contracts have a clause: guaranteed delivery timelines. If Samsung cannot deliver the batteries on schedule, the automakers can cancel the contracts and source from alternative suppliers. And right now, Samsung cannot deliver. They do not have the silver. They tried to secure 20 million ounces for Q1 2026. They got 8 million. That is a 60% shortfall. With 8 million ounces, they can produce approximately 250,000 battery packs. That is enough for pilot production. That is enough for testing, but it is not enough for mass production. It is not enough to fulfill the contracts. Samsung's executive committee, after reviewing the procurement failure, held a second emergency meeting on January 14, 2026. The meeting lasted 4 hours. According to sources who were present, the tone was described as grave. The chief supply chain officer presented 3 options. Option 1, delay the solid-state battery launch by 12 to 18 months until silver supply stabilizes. This option preserves the technology, but risks losing the contracts with the automakers. Option 2, redesign the battery to reduce silver content. This option maintains the timeline, but sacrifices performance. Early estimates suggest that reducing silver content by 50% would cut the range from 600 miles to approximately 420 miles, and increase charge time from 9 minutes to 16 minutes. That eliminates the competitive advantage. Option 3, acquire a silver mining company. Samsung would purchase a primary silver miner, vertically integrate the supply chain, and secure captive production. This option is expensive, likely requiring a $3 to $5 billion acquisition, and it would take 2 to 3 years to ramp production, but it guarantees long-term supply. The committee has not made a final decision, but the fact that they are considering option 3, the fact that a consumer electronics company is contemplating buying a mining operation, tells you everything you need to know about how desperate the situation has become. Meanwhile, Tesla is sitting on 85 million ounces. Tesla has enough silver to power their 2026 and 2027 production with a comfortable buffer. Tesla has removed the supply chain risk that is currently paralyzing Samsung, and that gives Tesla an unassailable competitive advantage. If you are an automaker and you're deciding whether to partner with Samsung for solid-state batteries or stick with Tesla's proven 4680 cells, and you know that Samsung might not be able to deliver because they do not have the silver, who are you choosing? You are choosing Tesla, every time. Let me show you why the Tesla procurement is not just about competitive advantage. It is about survival, because the silver shortage is not a 2026 problem. It is a 2026 through 2035 problem. The supply cannot catch up. Let me explain why. Silver mines take 8 to 12 years to develop from discovery to production. That timeline includes exploration, feasibility studies, permitting, financing, construction, and commissioning. Even if a company discovered a massive silver deposit today, even if they fast-tracked every step, the earliest that mine could produce metal is 2034. But here's the bigger issue. There are not massive silver deposits waiting to be discovered. The easy silver, the high-grade deposits near the surface, has already been mined. Modern silver deposits are lower grade, deeper, and more expensive to extract. The average ore grade for silver has declined from 15 ounces per ton in 2005 to approximately 4 ounces per ton in 2025. That is a 73% decline in ore quality over 20 years. To produce the same amount of silver, miners now have to process nearly 4 times as much rock. That requires more energy, more water, more equipment, and more time. And energy costs are rising. Diesel fuel, electricity, labor, all of the input costs for mining are increasing. At current silver prices of $90 per ounce, many primary silver mines are operating at or near break-even. If energy costs rise, or if ore grades decline further, those mines become uneconomical and they shut down. The only way to incentivize new silver production is to raise the price high enough to justify the capex and the operating costs. Industry analysts estimate that silver needs to trade consistently above $150 per ounce to trigger meaningful exploration and development of new primary silver mines. But even at $150, the new supply would not arrive until the 2030s. For the next 5 to 7 years, the supply is fixed. It is approximately 780 million ounces per year from existing mines. That is it. There is no surge capacity, there is no strategic reserve. The governments sold their silver stockpiles decades ago. The United States government, which once held billions of ounces of silver, sold its last remaining inventory in the early 2000s. There is no cavalry coming, and demand is accelerating. The solar industry alone is projected to consume over 230 million ounces in 2026. Electric vehicle production is expected to reach 17 million units globally in 2026, up from 14 million in 2024. Each EV requires 30 to 50 grams of silver, and if solid-state batteries gain traction, that number jumps to 1,000 grams per vehicle. Data centers driven by AI and cloud computing are expanding capacity at unprecedented rates. Data center power capacity has increased from 0.9 gigawatts in 2000 to nearly 50 gigawatts in 2025. That is an increase by a factor of 53 or 5,252%. Every server, every switch, every power distribution unit contains silver. The demand is structural. The demand is non-discretionary. You cannot build a solar panel without silver. You cannot build an EV without silver. You cannot build a data center without silver. And the companies that control the silver control the future. Now, let me show you the price trajectory. Because $120 per ounce is not the top. It is a waypoint. Yesterday, January 14th, 2026, silver closed at $92.25. That is a record nominal high. But that is still cheap. Let me prove it to you with math. Let us assume that Samsung decides they need to secure 100 million ounces over the next 2 years to salvage their solid-state battery program. Let us assume that Tesla's 85 million ounce purchase becomes public knowledge, and Apple, Google, BYD, and LG all decide they need to build strategic stockpiles. Let us conservatively estimate that these companies, combined, attempt to acquire 300 million ounces over the next 12 months. Where does that silver come from? It does not come from the mines. Mine production is already allocated. It does not come from recycling. Silver recycling yields approximately 180 million ounces per year, and that is already factored into the supply equation. It comes from existing holders. It comes from investors who bought silver at $30 and are willing to sell at $90. It comes from ETFs liquidating to meet redemptions. It comes from weak hands who panic when prices get volatile. But here's the key. To bring 300 million ounces to market, to convince existing holders to sell, the price has to rise high enough to overcome their reluctance. If you are holding physical silver and you know that Tesla just paid $140 to $160 per ounce, why would you sell for $90? You would not. You would wait. You would demand $120, $150, $200. And the buyers, the Teslas and the Samsungs, they are not price sensitive. They are supply sensitive. They will pay $120. They will pay $150. They will pay whatever it takes because the alternative is not having the metal and not being able to produce their products. This is how markets clear when supply is inelastic and demand is non-discretionary. Price goes vertical. We saw this pattern in palladium. In 2017, palladium was trading at $700 per ounce. By 2021, it hit $3,000. Why? Because automotive manufacturers needed palladium for catalytic converters, and the supply could not keep up with demand. Silver is palladium on steroids. Silver is used in more applications. Silver has more industrial buyers. And silver has the added dimension of being a monetary metal with investment demand. When investors realize that industrial users are panic buying, when they see Tesla securing 85 million ounces, when they understand that the vaults are empty, investment demand will surge. Retail investors will buy, institutions will buy, sovereign wealth funds will buy, and that adds another 200 to 300 million ounces of annual demand on top of the industrial consumption. The supply-demand imbalance becomes catastrophic. Comics cannot deliver. The ETFs cannot meet redemptions. The paper market breaks, and the reset happens. Here's the timeline. I'm going to walk you through the next 6 months, month by month. and show you the catalysts that are going to drive silver from $90 to $120 and beyond. February 2026. Comics. March silver contracts reach first notice day on February 12th. As of today, January 15th, there are approximately 45,000 contracts in the March delivery window. Each contract represents 5,000 ounces. That is 225 million ounces of potential delivery demand. The comics registered inventory is approximately 82 million ounces. If even 20% of contract holders stand for delivery, that is 45 million ounces demanded from a vault with 82 million. Comics will implement emergency measures. Margin requirements will be raised to force liquidation. Position limits will be imposed. Cash settlement incentives will be offered. But those measures only delay the crisis. They do not solve it. And when the market sees comics scrambling, confidence erodes. The price spikes. Estimate for end of February, $105 to $112 per ounce. March 2026. Samsung officially announces a delay in their solid-state battery launch. The press release will be carefully worded. They will cite supply chain optimization or additional testing requirements. But the market will understand. Samsung does not have the silver. The automaker contracts get renegotiated. Some get canceled. Samsung's stock drops. But more importantly, the announcement triggers panic among other EV and electronics manufacturers. If Samsung, with their resources and scale, cannot secure silver, what does that mean for smaller players? The scramble intensifies. Estimate for end of March, $118 to $128 per ounce. April 2026. Tesla announces record Q1 earnings driven by energy storage deployments. During the earnings call, Elon is asked about raw material costs. He does not mention the 85 million ounce purchase explicitly, but he says, "We have secured strategic materials for the next 24 months. We are not supply constrained." The market interprets this correctly. Tesla cornered the silver supply. Analysts start modeling the implications. If Tesla needs 18 million ounces per year and they secured 85 million, they have a 4+ year buffer. That means they can underprice competitors who are facing supply shortages. Tesla's competitive moat just widened. Tesla stock rallies. But more importantly, the Tesla earnings call is the moment when mainstream investors realize that silver is not just a commodity, it is a strategic asset. Investment demand surges. Estimate for end of April, $135 to $148 per ounce. May 2026. The first major silver ETF suspends redemptions. The fund, likely SLV or PSLV, announces that due to extraordinary market conditions, they are temporarily halting the redemption of shares for physical metal. The fund can still trade on the stock exchange, but investors cannot convert shares into bars. This breaks the arbitrage mechanism. The price of physical silver and the price of the ETF decouple. Physical premiums explode to $50, $70, $100 over the ETF price. Investors panic. They rush to buy physical coins and bars. Dealers sell out. Wait times extend to 16, 20, 30 weeks. Estimate for end of May, $158 to $172 per ounce. June 2026. China announces an expansion of their critical mineral export controls. Silver is officially designated as a strategic resource. Export quotas are reduced by another 20%. Western manufacturers are cut off almost entirely. The message is clear. China is hoarding silver for domestic use. BYD, KTL, and Chinese solar manufacturers get priority. Western companies get scraps. This is the same playbook China used with rare earth elements, and it works. At this point, the only silver available to Western buyers is from non-Chinese sources, and that supply is tiny. Prices in Shanghai decouple from comics. Shanghai trades at $200 per ounce, while comics shows $160. The arbitrage cannot close because there is no metal to move. Estimate for end of June, $175 to $195 per ounce. That is the roadmap. That is the next 6 months. And beyond June, the situation gets even more extreme because by mid-2026, the industrial buyers who did not secure stockpiles early, the Samsungs, the LGs, the smaller EV startups, they face a choice. They either halt production or they pay whatever price is necessary to keep the lines running. And they will pay. They will pay $200. They will pay $300. Because the cost of silver, even at $300 per ounce, is still a tiny fraction of the total cost of an electric vehicle. An EV that sells for $50,000 contains 30 to 50 grams of silver at current usage rates. At $90 per ounce, that is $90 to $150 worth of silver. Even if the price triples to $270 per ounce, the silver cost is still only $300 per vehicle. That is less than 1% of the vehicle's price. Manufacturers will pay it. They have no choice. Let me bring this back to the central thesis. Tesla's 85 million ounce purchase is not just a procurement decision. It is a chess move. It is Elon Musk looking 3, 4, 5 years into the future and realizing that the companies that control the critical materials will control the industries. Tesla is not trying to manipulate the silver market. They are trying to insulate themselves from a supply chain that is breaking. And in doing so, they have accelerated the break. Because now every other CEO, every other CFO, every other supply chain director at every major tech and automotive company is looking at what Tesla did and asking themselves, do we need to do the same thing? And the answer is yes, they do. But the silver is not there. Tesla took it. And that is why Samsung is facing a crisis. That is why the solid-state battery launch is in jeopardy. That is why the price is going to $120, $150, $200 per ounce. Because the industrial demand is real, the supply is finite, and the realization is spreading that this is not a temporary shortage. This is a structural deficit that will last for the rest of the decade. Now, let me tell you what this means for you. If you are holding physical silver, you are holding the asset that the most sophisticated companies on Earth are panic buying at premiums of $50 to $70 over spot. You are holding the asset that Tesla just paid $140 to $160 per ounce to secure. Why would you sell at $90? You would not. You hold. You wait for 120, you wait for 150, you wait for 200. Because this is not a trade. This is a supply squeeze. And supply squeezes do not resolve gently. They resolve violently. They resolve when the price goes high enough that demand destruction occurs. When manufacturers stop using silver because it is too expensive. When products get redesigned. When industries shut down. Well, what is that price? We do not know. But based on historical precedent, based on the math, based on the fact that silver is less than 1% of the cost of most finished products, that price is likely north of $250 per ounce, maybe higher. And if you are sitting in cash, if you are waiting for a pullback to buy, you need to understand that the pullback might not come. Or if it comes, it might be from 110 to 95 before the next leg up to 140. The window is now. The window is today, January 15th, 2026, while the COMEX price still shows $90 to $92. While dealers still have inventory, even if you have to wait 12 weeks for delivery, while the Tesla procurement has not yet become mainstream news. Because once this story breaks, once the financial media picks it up, once retail investors understand that Tesla outbid Samsung for 85 million ounces, the rush begins. The premiums explode, and you will not be able to buy at 92. You will be paying 120, 130, trying to catch up to a market that has already moved without you. This is not financial advice. This is not a recommendation, but I'm telling you the facts. Tesla secured 85 million ounces. Samsung failed to secure 20 million. The vaults are at 70% depletion since 2020. Industrial demand exceeded supply by 270 million ounces in 2024. The deficit is worsening. Solid-state batteries require 1 kilogram of silver per vehicle. Solar, EVs, data centers all accelerating. Mine supply is fixed, and the price yesterday hit a record high of $92.25. The market is telling you something. The industrial users are telling you something. Tesla is telling you something. The question is, are you listening? The battle for silver has begun. Tesla won the first round. Samsung lost. And $120 is not a forecast. It is the next waypoint on a journey that ends much, much higher. This is the silver battery war, and the price of victory is measured in ounces secured today, not dollars, saved tomorrow. The heist is complete. The metal is gone. And the companies that did not act are about to learn a very expensive lesson about the difference between paper promises and physical reality.